is here to discuss the markets. And Sarah, it's interesting because we heard that about retail investors, obviously pretty enthusiastic to put money into this market at the start of the year. It's a very generous liquidity situation. The basic fundamentals in terms of economic growth and earnings growth seem in place, and yet we have to absorb these policy volleys from time to time. So where does that leave you in terms of what's going to most influence this market for now?
The tug of war this year so far has been the macro versus the micro, and those are around three issues, which are geopolitical, Fed tensions, and of course earnings. So we actually settle on earnings. We expect over 10% earnings growth in 2026, and that should be what supports the market going forward. But we do have to acknowledge the fact that we came into the year at a premium in terms of market valuations. So these ongoing geopolitical issues and Fed tensions could cause the market to be quite volatile, but we are seeing a very strong earnings season so far. And in general, earnings tend to carry markets forward, and we have a good earnings outlook for 2026.
They do, and I wonder what you're thinking about the composition of that earnings growth, because really for over a year, there's been this vigil for when, earnings growth will broaden out to the majority of stocks as opposed to really being unduly driven by the very largest stocks. We now have a situation where we can see that potentially happening late this year, but still the best growth, certainly in aggregate dollars added, is in the large tech stocks. So how does that inform your view?
Well, that's been an ongoing battle for a few months now, which is tech versus the rest. So the Mag 7 versus the S&P 493. But taking a look at the data, tech earnings should be 2x S&P 500 earnings this year. So I follow the data. Tech earnings still look strong. Question mark around them, of course, is how much of this AI spend will turn into productivity. That is a question mark. There could be somewhat of a lull between how much we've spent on artificial intelligence and when that turns into real productivity gains. But it will do that, and the earnings growth is still there. So we have tech earnings starting in, really in aggregate in a couple of weeks from the Mag 7. I think you're going to see strong earnings from companies like Meta, from Alphabet, and that's going to get this tech rally to continue, which we are seeing today. Earlier this week, it was more about defensive leading. It was a safety trade. Today, it's switching because of TSMC to tech leading the markets.
Yes, and that's been, the market has actually benefited from that, kind of on a given day, have some new leadership, hold the market together while other things take a rest. That has been valuable. On the policy front, there has been this consensus coming into this year that it was going to be very favorable in the way of fiscal tailwinds that were developing, and we could kind of do the math on how that was going to help growth, put money in investors' pockets, and maybe generate even more corporate capex. And then we come into the year and it's a lot of these sort of policy suggestions, to put it lightly, about certain industries shouldn't buy back a lot of stock, or we're going to cap credit card interest rates. Can we properly ignore some of that stuff, or do we have to take into account what the affordability push from the White House is going to mean for companies?
There's going to be continuing noise around policy for the markets, and what we can and can't ignore is going to be crucial in terms of volatility. Three themes for this year, though: affordability, deregulation, some tax relief are going to be positive. So we've been dealing with this K-shaped consumer where the high-end consumer continues to spend, but the lower-income consumer is struggling, even more so because of high tariffs and inflation. So anything around affordability could be positive for helping to stabilize the entire consumer base. Deregulation, positive for financials, which are reporting strong earnings again this week, as we're seeing strong capital markets and M&A going forward. All of those should be positive, as well as some tax relief. Those will be the longer-term themes, but I do think that within that, we're going to get a lot of noise and volatility, not only around policy, but geopolitical issues. We're watching the Middle East closely to see what happens there, as well as other areas where there's continuing conflicts like Russia, Ukraine, and of course watching the U.S.-China relationship very closely.
For sure. Who knows? We might get a tariff ruling at some point, and all the rest of it as well. Apart from that, if I look at parts of the market that have seemed to be priced at a little bit of a discount, or at least are less aggressively owned and loved, things like quality, things like defensive, things like low volatility and staples and such as that have definitely screened out that way. Are they cheaper for a reason, or do you think they're worth having?
Well, follow the earnings growth. We start with tech leading the pack for this year. Secondarily, where I would look is materials and industrials, which also have strong earnings growth. Staples tend to look cheap, but they tend not to have the earnings growth to go with them unless you're in a very recessionary environment. The economic data is not pointing to that. Another area, though, that tends to be defensive is utilities. There's a company we like there, NiSource, which is an Indiana-based utility, has very strong customer growth. Building out AI data centers are going to be beneficial for them. That's the Midwest is strong for utilities. That's a defensive stock that we like. I'd be a little more careful on consumer staples because they tend to just lead when markets are afraid. And the economy and earnings are telling you that the markets likely will have a lot of support from fundamentals this year.